and welcome to this video about the sale of property in India by non-resident Indians or NRIs. Today we'll be addressing some common questions and concerns that you as an NRI might have when it comes to selling property in India. But before that, let's start by clarifying the types of property that NRIs can purchase in India. As an NRI, you have the opportunity to invest in residential or commercial properties such as houses, apartments or land plots. These investments can be lucrative. However, there are restrictions on certain property types. You cannot buy agricultural land, farmhouses or plantations as an NRI. Today we are diving into the ins and outs of selling property in India as an NRI. We'll break it down step by step and make it easy to understand. So let's get started. First things first, what are the basic conditions for selling property in India as an NRI? Second is documents for finalizing the sale transaction, and here we're going to talk about the paperwork requirement. Third is the tax implications on the sale of property in India, and here we discuss capital gains tax applicable by selling the property. Fourth, we will understand after selling the property how you can take the money back to the country where you're residing. And then we have two important questions about TDS rules and how we can lower the TDS. Apart from that, how can we save tax too? This we will discuss in the second part of the video. So make sure you subscribe to our channel. So without any delay, let's get started. We're going to unravel the basic conditions for selling property in India as an NRI. It might sound a bit complicated, but don't worry. I'm here to break it down for you in an easy way. So let's dive right into it. When you're an NRI looking to sell property in India, there are a few rules and conditions you need to keep in mind. These rules are set by the Foreign Exchange Management Act or FEMA and the RBI, which plays a key role in regulating these transactions. Now, selling a property as an NRI isn't all that different from what a resident Indian would do, but there are some additional provisions you need to be aware of. Let's go through them. As an NRI, you have the green light to sell any property you own in India. It could be residential, commercial, and it doesn't matter if you've bought it or inherited it. No need to seek permission for this from the RBI. Here's an interesting tidbit. You can sell your property to both residents and non-residents of India. That's right. You have a wider pool of potential buyers. However, there's a small twist when it comes to agricultural land, which you can only sell to a resident Indian. Now, here's an important note. Regardless of whether you've struck a deal with a fellow NRI abroad, the sale transaction must be conducted in Indian rupees. So even if you've discussed all the details while sipping coffee overseas, the actual sale should be in good old INR. That's a wrap for the basic conditions when selling property in India as an NRI. Remember, it's not as complicated as it might seem. Just make sure to follow these guidelines and you will be on your way to a smooth property transaction. Let's continue our journey through the process of selling property in India as an NRI. Now we're going to talk about the essential documents you'll need to finalize that sale. So grab your notepads and let's get to it. Now, before you even think about selling your property, there are a few crucial steps to follow. First things first, you need to assess the value of your property. Sure, you might get some ballpark figures from brokers or online websites, but the actual value depends on several unique factors of your property. So take your time to get a realistic valuation. The key to a smooth sale is impeccable documentation. You want to make sure that all your paperwork is flawless. This ensures that it does not become a bargaining point for the buyer later on. It's also essential to pay all the taxes and utility bills related to the property up to date. You don't want any financial skeletons popping up during your sale process. Here's a tip. Be transparent. Let the buyer know that you're a non-resident. Now, this is important because the buyer will have additional responsibilities in the transaction due to your NRI status. Now, let's dive into the documents you'll need. If you already have a PAN card from your time in India, great. If not, don't worry, you can apply for a new one online. Just make sure you provide proof of residence like a copy of your passport or bank statement from your country of residence. This should be attested by the Indian Embassy or High Commission, or you can get an apostille or bank manager's attestation. The PAN card is crucial for obtaining tax deduction certificates, which we'll discuss later. If you have any rental interest or other income in India, you need to regularly submit your income tax return. Copies of these returns will be required to confirm that all your income tax dues are in the clear. As an NRI, your passport is your primary legal identity proof, so have it ready for verification during the registration process. You'll also need documentary proof of your address in India and abroad. Copies of documents like insurance policies, ration cards, Aadhaar card, our recent telephone, electricity bills, perhaps, of course not older than a month, will do the trick. For selling a property, you'll need a copy of the approved building plan. And don't forget the occupancy certificate, which proves that your apartment has been approved for occupation by the local authority. If your property is part of a society, you'll need a letter from the society confirming that all dues have been paid and they have no objection to the transfer of ownership. Lastly, the encumbrance certificate. This is crucial to ensure there are no encumbrances on your property, such as mortgages or borrowings. And there you have it, a checklist of documents you'll need to finalize your property sale. Remember, impeccable documentation is your ticket to a hassle-free transaction. I know taxes might not be the most exciting topic, but understanding them can save you some serious money. So let's break it down in a way that's easy to digest. You're probably familiar with income tax, which is what you pay on the income or gains you earned or received in India. All the incomes earned are categorized into 5 different heads of income. So when it comes to making a profit from buying and selling assets, including properties, such income is categorized as income from capital gains. Now, the first thing to know is that capital gains can be classified as either short-term or long-term. And what determines which one it is? Well, it's all about how long you hold on to the asset. If you sell a property within 2 years of purchasing it, any profit you make is considered a short-term capital gain and it's taxed at 30%. On the other hand, if you hold on to the property for more than 2 years before selling it, the property falls into the category of long-term capital gain and it's taxed at a rate of 20%. Now here's the kicker. There might be an additional surcharge ranging from 10% to 15% based on your taxable income, and there's an educational cess of 4% on top of the calculated tax as mentioned earlier. Let's understand one more interesting fact, that imagine you might have spent money under different heads while selling the property. You can adjust those expenses from the selling price. To that extent, your taxable profits, what we call as capital gains, would come down. So income tax department says expenses like brokerage, commission, advertisement expenses, etc. are allowed expenses. This is crucial information, especially if you plan to settle elsewhere and want to take your hard-earned money with you. So let's get to it. First, it's important to note that repatriation from the sale of agricultural land or plantation is not allowed. However, when it comes to other types of properties, the rules differ. Let's break it down under 3 conditions. First, sale of inherited property. Second, sale of property purchased as a resident Indian. And number 3, sale of property bought as an NRI. Let's see the first condition. After the applicable TDS, the proceeds from the sale of an inherited property should be credited to your NRO account by default. You can repatriate funds from your NRO account of up to $1 million per financial year, but this is subject to the submission of documentary evidence of inheritance and other required documents for remittance. This typically includes Form 15CA and 15CB. And if the property was inherited from a person of overseas residency, specific permission from the RBI is required for repatriation. Similar to inherited property, the sale proceeds after TDS must be credited to your NRO account. You can repatriate funds from your NRO account of up to $1 million per financial year, again subject to the submission of necessary documents for remittance. However, there's a catch here. You can repatriate the sale proceeds only if you have held the property for more than 10 years. If not, the sale proceeds will have to be retained in your NRO account until you complete 10 years of ownership. Additionally, you can repatriate sale proceeds of only 2 houses and no more. Next, if you purchase the property using funds you had left in your NRO account, be it a loan from a bank or relatives, the repatriation rules are the same as mentioned for inherited property. If you took a loan from an overseas bank to buy the property, repatriation is allowed up to the amount remitted through your NRE account or directly through banking channels for the property's purchase. If you bought the property using funds in your NRE or FCNR, foreign currency non-resident account, repatriation will be limited to the foreign currency equivalent of the amount paid for the property's purchase. Capital gains are to be deposited in your NRO account to be repatriated, subject to the limit of $1 million and other compliance conditions. It's important to note that repatriation is allowed in respect of 2 residential properties only, though there is no restriction on the sale of commercial properties. That was quite a bit of information, but it's essential to understand these rules when considering taking the funds out of India. Always consult with your financial experts or professionals to ensure compliance with these guidelines. As we wrap our discussion on property transactions for NRIs, here's a crucial point to remember. There are no restrictions on the purchase of non-agricultural property by an NRI in India. You must comply with FEMA and RBI regulations when it comes to the sale of the property and repatriation of the proceeds. To ensure a smooth and hassle-free transaction, it's essential to start the documentation process well ahead of time. This proactive approach will help you navigate the complexities and requirements effectively. And here's the summary of all that we have discussed so far. These 5 aspects have been discussed in this video. First, NRI's property investment, where NRI can invest in residential and commercial properties but cannot purchase agricultural land, farmhouses, or plantations. Second is sale transaction. Sale must be in Indian rupees and they can sell residential as well as commercial properties to both Indian residents and non-residents, but agricultural land can only be sold to resident Indians. Third is documentation. Essential documents include PAN card, income tax return, passport, address proof, encumbrance certificate, etc. And all documents should be perfectly done to avoid any hassles in the transaction process. Fourth is capital gains tax. When you sell before holding an asset for 2 years, any profit is considered a short-term capital gain, which is subject to a tax rate of 30%. And when you sell after holding an asset for more than 2 years, any profit is considered a long-term capital gain, which will be subject to a tax rate of 20%. And an additional surcharge and education cess are applicable too. Fifth is repatriation of sale proceeds. It's allowed under specific conditions with limitations. One can repatriate up to $1 million per financial year. And necessary documentation like Forms 15CA and 15CB are required. Apart from that, only 2 residential properties proceeds can be repatriated, but there's no restriction on commercial properties. So that's a wrap. Thank you all for joining us today, and I hope you found this information valuable. If you have any more questions or need further assistance, don't hesitate to reach out to the relevant authorities or seek professional advice. Property transactions can be significant milestones, and it's essential to get them right. Stay informed, stay compliant, and have a wonderful day ahead.